Hello everyone, welcome to Investor Education Program. The topic today we are going to discuss is options and goods. And just to let you know, everyone would be on listen and only view mode. So if you have any question, you can post it on Q&A session. Before going to options and goods, we'll be discussing about overview of the commodity derivatives ecosystem. Coming to evolution of commodity exchanges, commodity trading dates back to 19th century by starting of Bombay Cotton Trade Association in 19th century, and after that followed by in 1910 to 1930 it followed by in 1910 to 1930 oilseeds and jute were traded, and after that in order to regulate these forwards trading, forwards market commission was established in 1953, and in later 20th century forwards trade was banned in India. Forwards of futures trade was banned in India, and in 2001 again government gave permission for the commodity derivatives to be traded in India, and in 2003 few multi commodity exchanges like multi commodity exchange and CDX, these are the national level commodity exchanges that have been formed and started operating from 2003. And in 2015, till then, the Forwards Market Commission was the regulator to regulate these exchanges. But from there, SEBI has become the sole regulator for all the exchanges, whether it's commodity derivatives or uh, stock exchanges. And coming to the structure of commodity exchanges in India, NCDX, MCX, ICX, and NSE BSE. These are the national level exchanges that are present in India. NCDX mainly deals with agri commodities. MCX deals with mostly non-agri space like metals, energy, that is crude, bullion, that's gold and silver, etc. NSE BSE, obviously, you know that they deal in the equity market. And coming to and these all national exchanges come under Securities and Exchanges Board of India. That's the regulator, and SEBI comes under the Ministry of Finance, Department of Economic Affairs. And as I've told you, in 2015 September, SEBI have taken over as regulator, and after that, these are the few steps that SEBI have taken in order to uh, promote the derivatives trading in India. So SEBI permitted options in commodity derivatives from June 2017. Before that, there were no options in goods, and also from 2017 June, SEBI also permitted Category 3 alternate investment funds to participate in the commodity derivatives segment. And from September 17th, And from September 2017, SEBI permitted the integration of both equity and commodity arms of broking. That is, if any broker or member is dealing in the commodity markets, before 2017, they used to have two different arms of broking. Like for example, angel broking used to have angel equity separately and angel commodity as separate entities, but now they are both integrated so that with a single application, a trader or an investor can trade in both equities as well as commodities. And banks are allowed to participate in the commodity derivative products, and also they can act as professional clearing members from 2017. In 2018, foreign portfolio investments were permitted to hedge their position in Indian commodity markets. And in 2019 March, PMS and mutual funds are also allowed to participate in the market. And in June, from June 2019, commodity indices were also allowed to trade. And these are the listed commodities that are able to trade. That is, they vary from cereals, pulses, spices, fibers, guar complex, and oil seeds. In cereals, we have bajra, barley, chana, maize, wheat, moong, and paddy. In spices, coriander, jeera, and turmeric. In fibers, it's mostly the cotton complex. It's cotton seed oil and cotton seed oil cake, kapas, as well as cotton. And in guar complex, guar seed and guar gum. In oil seeds, we have soybean, refined soya oil, mustard, castor seed, crude, CPO, that's crude palm oil, and sesame seed. And coming to the differences between the commodity and financial derivatives, commodity derivatives actually get settled into actual deliveries, that they delve into the physical commodity, whereas financial derivatives, they are only cash settled. And in commodity derivatives, there are quality and quantity differences that exist, but in financial derivatives that doesn't happen because there is no existence of such a physical product there. And coming to holding costs, in order to carry a physical commodity, there incurs some cost because it could be a warehouse cost, or in order to purchase them, the capital is blocked, so interest costs. In order to secure them, insurance costs, and assaying. Mostly these are the holding charges that are involved in that. But whereas in financial derivatives, holding costs only include the interest costs. Other than that, no other costs are generally seen. So in physical markets is seasonal in nature. Like for example, a an agri commodity is produced mostly in a particular season, but it is consumed throughout the year. Whereas in cash markets, they are active throughout the year. And factors that impact the commodity derivatives are mainly demand supply issues, import export regulations, government intervention. Whereas factors impacting financial derivatives are global and local economic condition, their performances such as GDP or any other parameter that is considered, and performance of a particular sector that the company belongs to, and also its taxation structure. For example, if you take tobacco or alcohol, these are highly taxable in India. And now coming to options. Option is nothing but a financial derivative which gives right but not the obligation for the buyer to buy or sell an asset at a fixed price on or before a given date. So this is quietly different from the future. In future, what happens is you lock your price. So in order, if you are a buyer of the product, and if you lock your prices, if the prices go down in the future, there is a chance that you missed, that you may procure at a cheaper rate, but you are procuring at the same rate that you have on which you have locked the prices. So in options gives that flexibility in order to take an opportunity if the prices also move down. In order to take that, you have to buy a call position. And what is call and put will deal them in the next slides. And period of time could be as short as a day, or for it varies from a day to years, because it depends on what type of option that you are trading. And coming to call option is generally a buy option. That means a buyer of a call option have a right but not an obligation to buy the commodity. For example, if I'm a processor, what risk does I have that the commodity that I'm going to process uh, price may increase? In order to limit the price risk that I have, I can go to a futures contract where I can lock my price. But what happens with that is, if the prices go down after that, after I lock my prices, I'm going to lose the opportunity that I have, that I can procure at a cheaper rate from the market. So in order to if one wants to avoid it, what that processor have to do is he have to buy a call position where he have the right that if he wanted to buy at a particular rate, he can buy, or else if he is getting it from the market at a cheaper rate, then he can buy from the market, leaving the contract uh, that he bought. So here, the buyer of a contract in options, the buyer of a contract have to pay some premium to the seller of the contract in order to uh, execute in order to buy it, because there is risk exists only for seller here. The buyer is not going to face any risk. So it's same for the put options also. If I'm a farmer, what risk does I have? I have a risk that while selling my produce, the prices may go down. So if I in the same way, if I go and lock my prices using a future derivative, what happens is if the prices move up, that is against me. So in that case, I have lost an opportunity to sell in the market at a higher price. So if the farmer paying by a little amount as premium to the seller of the put option, he can uh, what he gains from that is he if the prices in the uh, physical market are higher than the price that he uh, that the price he have made the contract, that is generally called strike price. If it is higher than that, he can go and sell it in the physical market. If the prices are lower than that, he can execute the options contract. And basic terminology that generally that is present in the options is exercise. Exercise is nothing but I've told that the buyer have right but not obligation. If the buyer executes his contract, when does he execute his contract? That is when the strike. If it is a put option, that means it's a sell option. So when the prices in the market are lesser than what the price I have fixed with the seller, then only the put option gets executed. And premium is the total cost of the option. That is the holder of the option generally pays this premium to the writer or seller of the option in order to, as the risk is taken by the seller of the option. And strike price is the price at which both these parties agree in order to exercise this contract. And writer is the seller of the contract and holder is the purchaser of the option. And I've told that there is an option, there exists an option premium which is paid by options holder to options writer. So it consists of what options premium is generally made of. It has two content in it. It can be broken into two parts. That is intrinsic value and time value. That is, uh, if right now uh, I have made a, if I'm a farmer and I have bought a put option at 5,000 rupees, and the prices that are present in the physical market right now is 4,500. And what does that mean? I as a farmer, if the prices are the difference between the strike price and the price that is actually existing in the strike price and that is actually existing. This difference is generally called as intrinsic value. You see, for a call option, intrinsic value is spot minus strike. For a put, it is strike minus spot, because they are all these both are having the opposite positions. Like for call, it is a buy option, and for put, it is a sell option. So the difference exists here, and yeah, told that the intrinsic value is the amount by which an option is in the money. We'll see what is in the money. And coming to time value, this is a part of option that is based on time of expiration. That is, if I'm going to take an option which expires in March, that is it is 3 months away. So the time value for it is more rather than the option uh, of February, because as the time increases, the chance of the options getting exercised is more, or the risk is more. So the time value here is mainly the time of how long the time of expiration is. So the option premium is based on these two values, that is intrinsic value and time value. And coming to options moneyness, at the money contract is an option whose strike price. Sorry for the disturbance. Options money. Coming to options moneyness, at the money options is nothing but an option whose strike price is equal to the market price, that is spot price, and in the money option is uh, for call options, it is the market price of the underlying security that which are present above the strike price. If it is a put option, the market price of underlying security that is below the strike price of the option. And out of the money contracts are the opposite. Like apart from these at the money and in the money contracts, sorry, options that are present, all the other existing options are out of the money options. Coming to options moneyless, I can explain you better here regarding the in the money, at the money, or out of the money contracts. Let us assume that the market price that is existing right now is 4100, and if it's a call option, 4100 is, and the strike that is present over here is 4100, and that is the at the money contract, at the money option, and the prices that are below the at the money option comes under the in the money, and which are present above the at the money or this at the money strikes comes under the out of the money options. And if it is a put option, it's opposite. And as the at the money option doesn't change because the physical price is 4100, and for put option 4150, 4200, and 4250 are the in the money contract, in the money options, and below it are out of the money options. Because why 4150 is in the money? Because if if uh, if a buyer buys 4150, buys at 4150, he can sell more than the existing market price. That means that it is giving an extra money to the buyer over here. So that is in the money. And whereas even though the market price existing is 4100, I'm going to buy it, if I'm going to buy a strike of 4050, that becomes out of the money. Though an opportunity, better opportunity is existing in the market, I'm going to buy or sell here. So that is the options classification. That is, if market price is more than strike price, for call option they comes under in the money, but for put option they go as out of the money contracts. And for if market price is lesser than strike price, call option it's out of the money, and for put option it's in the money. And at the money contracts are same for both of them. And near the money are the contracts that are present around the at the money contract. Coming to options in goods, as a farmer, if a farmer X is going to sow his crop in July, which gets harvested in October, that's we are talking about maize here, and his plantation and harvesting costs that are incurred would be equal to 1100 per quintal, and he is expecting a profit of 650 rupees per quintal. So how can he get it? So he can lock the price generally. So how can he lock the price? One thing is to enter into a contract with a company, that's called contract farming generally. So or else selling the futures contract, because he is a producer, that is he's having the produce in the physical market, so he can sell it in the futures market in order to downside insured risk, but no upside potential. That is, if the prices move up in the market, there is no, even then he needs to he has the right, sorry, he is obliged to sell at the price that has been fixed. So other option that he have in order to lock this price is buy put option. So we'll see how. The farmer can buy put option in July, which has an October expiry. That is, at the time his crop, he is going to harvest his crop in the month of October. So, and if he can buy a put option which having a assured, that is strike at a strike price of 1750, then he have the right but not the obligation to sell his crop. That is, his downside is protected, but his upside is unlimited. That is, if the prices are going to rise in the market, then he can sell in the market, or else if the prices are going to get down, then he have already made the contract that he can sell his produce to the buyer of the produce over here at at the price that is already defined, that is 1750. So we'll see an example over here. Rate of price ensured fix, that is, if the farmer buys a future options contract, what happens? If he doesn't buy, what happens? If the prices decrease 350 rupees per quintal, so what happens over here is the total cost, that is, if he buys a options contract, the cost to grow here is constant, that is 1100, and the premium that he needs to pay in order to buy this contract is by that strike is 100 rupees. So his total cost comes to 1200, because he have given a premium of 100 rupees, and the assured price that he gets is 1750. And now if the prices get to, if the prices decreases by 350 rupees, what scenario happens here is the profit or loss that he booked, if the prices at the 20th October is 1400, what profit he makes if he bought an option, it's 550, because his downside is limited, because he can sell it in the he can execute the options contract and sell it at a price of 1750. But if he doesn't take an options contract, what would happen? Uh, he would make a loss of 300 rupees. That is, you can see here the his cost was 1100 rupees, and now he's making a he's selling at 1400 rupees. So he would make a profit of 300, but he would lose the best opportunity that existed. And if the prices decreases by 1600, decreases by rupees 150, then here the profit he would make is 550, that is 1750 minus 1200, and the profit or loss that he would make in options is he would lose 500 rupees. And it's same, if the price increases by 150 rupees, he can sell it at 1900 rupees and he would make a profit of 700. But if the prices got increased, the 100 rupees difference always exists in the upside, because that amount he have paid as premium, which as incurred cost. And difference between options in goods and options in futures, if you exercise the position in options in goods, they develop into the physical delivery, and that is to be settled at a final settlement price. On exercise, options delve into underlying futures if it is options on futures. And to have OOG on commodity, futures on that commodity should be present. The average daily turnover of underlying futures of the corresponding commodity during the last 12 months shall be at least 200 crore. And coming to benefits of options, Indian commodity derivatives market witnesses only will witness only two options, that is both the options, European as well as American options. European options can be executed only at the end, at the expiry, whereas American options can be executed in the total period of time, whenever it can, whenever the buyer want to execute it. It will play a major role in stimulating agricultural marketing because it can act as an insurance. This is a progressive step towards integration of spot and derivatives market and reduce the risk for hedges also, that is farmers or processors. It gives greater flexibility to exchanges to introduce products that cater to large section of stakeholders. And options in goods are available in 3 commodities from 27 July 2020 in maize, RMC, wheat. Buyer gives that is the premium. Here existing is the initial margin on options in goods. Here buyer of the commodity have to give premium and seller have to give initial margin because seller has the whole risk. So some margin should be collected in order as a risk management practice. For maize it is 10% and for RMC it is 8% and for wheat it is 8%. So this varies depending on the volatility of the commodity. And for chana, guar gum, guar seed and soya bean from 3rd September, the options in goods were available. And the premiums that are to be paid is 12% by the seller because buyer only pays premium in options. It's 12, 15, 15.3, 12 and 10% for all this. That's chana, guar gum, guar seed and soya bean. Coming to investor guidelines, these are the following things that investors should follow. They have to read SEBI or exchange guidelines in order before trading on the exchange. Trade only through the registered exchange members and fill your KYC before start trading. And every client have unique client code. Insist on rights and obligations and risk disclosure documents before trading. Insist on the contract notes for every settlement that are given by clearing corporation. Ensure that the contract notes contain all relevant information such as member registration, order details to know the authenticity of it. Cross-check the trade genuineness through trade verification facility available on exchange websites. Pay required margin and that is initial margin and MTM margin in order to avoid any penalties. Be aware of risks associated with DAPA trading. Issue the account pay check or demand draft in the name of only broker, not in the name of APs. Insist on periodical statement of account of funds and securities from the broker and check your accounts or tally with them. Portfolio management services are not permitted in the commodity market. Be aware before parting funds under the portfolio management. Funding from unauthorized intermediaries aren't covered under settlement guarantee mechanism of exchange, so be aware of it. And these are the things that investors shouldn't do. Don't deal with unregistered intermediaries. The list of members is already available on the exchange website. Don't undertake off-market transactions. Don't get carried away by luring statements or advertisements made by any of the brokers. Don't start trading before understanding risk disclosure clause. Don't accept unsigned or duplicate contract notes. Don't fall prey to the market rumors or any assured returns. Don't take positions against your capacity. Don't miss on keeping track of your financial position against the obligations that you have. Don't go by reports or predictions made by print or electronic media. Do your research on or analysis before trading. Thank you. If you have any questions, please put it on Q&A session. I don't think anybody's having any question. Thank you.